Most people assume that hiring a financial advisor means someone is working in their interest. You pay them, they manage your money, it grows. Intuitive transaction. And in a very specific, legally precise sense, not what's actually happening for the majority of Americans working with financial advisors today. There's one legal distinction almost no one has heard of. It determines whether your advisor is required to act in your best interest or merely required to recommend products that are adequate for your general situation. The difference between a fiduciary standard and a suitability standard is the single most important fact in personal finance that almost nobody discusses before signing. The paperwork. Get it wrong, and the financial consequences can run into tens, sometimes hundreds, of thousands of dollars across a lifetime of investing. This is not an argument against all financial advisors. For people with genuinely complex situations, estate planning, business succession, multi-generational wealth, the right advisor can be one of the best financial decisions you make. But for the majority of Americans with straightforward needs, someone building retirement savings through a 401k and a couple of IRAs, a couple saving for a house and retirement at the same time, a retiree managing withdrawals, the advisory relationship they've been sold may be costing them far more than it's worth. This video explains exactly how. Start with the distinction itself. A fiduciary is legally required to act in your best interest at all times. Recommend what's best for you. Disclose all conflicts of interest. Put your financial welfare above their own compensation. A non-fiduciary, a broker or advisor operating under the suitability standard, is only required to recommend products that are suitable for your general situation, age, and risk tolerance. Suitable does not mean best. It means adequate. A mutual fund charging 1.5% in annual fees when a comparable fund exists for 0.05% is still suitable if it fits your general investment profile. Recommending the more expensive fund, which pays the advisor a larger commission, violates nothing under the suitability standard. It would violate the fiduciary standard. That's exactly why the distinction matters so much. According to a 2024 NAPFA survey, fewer than 15% of Americans know whether their financial advisor is a fiduciary. Most simply assume they are. That assumption is wrong more often than it's right. The majority of registered representatives, broker-dealer advisors, and insurance-based advisors in the United States operate under the suitability standard, not the fiduciary standard. They're legally permitted to recommend products that serve their compensation interests, as long as those products aren't outright unsuitable for you. The person sitting across the desk may be a genuinely good person who cares about your outcomes. The legal framework they operate within doesn't require them to act like it. Compensation is where this plays out in practice. Financial advisors in the U.S. earn money several ways. Some charge a flat or hourly fee, completely disconnected from what you invest or how much. Some charge a percentage of assets under management, typically 0.5% to 1.5% per year. Some earn commissions on products they sell, mutual funds with front-end or back-end loads, annuities, life insurance products. And some earn all three. Simultaneously, through arrangements their clients rarely see disclosed clearly. The fee-only model, where the advisor is paid exclusively by you and earns zero commissions from product sales, eliminates the most direct conflict of interest. A fee-only advisor has no financial incentive to recommend one fund over another based on which one pays them more. They get paid the same whether you hold Vanguard index funds or high-fee actively managed products. And here's the math almost nobody walks you through. Picture two investors who both start with $100,000 and contribute $500 a month for 30 years. Investor A holds low-cost index funds in a self-directed account, average annual expense ratio of about 0.05%. Investor B holds a portfolio recommended by a commission-based advisor, average fund expense ratio of 1% plus a 1% annual advisory fee, total cost around 2% per year. At a gross market return of 8% annually, Investor A ends the 30-year period with roughly $875,000. Investor B, paying that 2% drag every year, ends the same period with roughly $567,000. The difference is $308,000. not because of different market performance, not because of better or worse stock picking, purely because of annual fee drag compounding against the portfolio for 3 decades. The advisor managing Investor B's money earned approximately $200,000 in cumulative fees from that portfolio. Their client made $308,000 less than they could have in a cheaper alternative. The transaction worked extremely well for the advisor. It was extremely expensive for the client. According to the Department of Labor's analysis of advisor conflicts of interest in retirement accounts, conflicted investment advice costs Americans approximately $17 billion per year in excess fees and underperformance. The exact number gets debated, but the underlying dynamic it describes is documented extensively and not seriously disputed by anyone in the industry. 6 situations where the advisor relationship may be working against you. Situation 1. You're paying an asset-based or commission-based fee on a simple long-term portfolio that could be managed in a self-directed account for a fraction of the cost. A 40-year-old with $200,000 in savings building toward retirement through broadly diversified index funds does not need ongoing advisory management. They need an asset allocation that fits their timeline and risk tolerance, an automatic rebalancing mechanism, and the discipline to stay invested through volatility. None of that requires paying 1% per year indefinitely. That 1% compounds to approximately $180,000 in lost wealth over 25 years on a $200,000 starting balance growing at 7% gross. Money paid for a service a target date retirement fund provides automatically for about 0.12% per year. Situation 2. You're in an annuity or insurance-linked investment product you don't fully understand. Variable annuities are among the most consistently profitable products in the financial services industry for the providers and advisors who sell them, and among the most consistently expensive for the clients who hold them. A typical variable annuity carries total annual costs of 2% to 3.5% when you add the insurance charges, sub-account expense ratios, and optional rider fees. Surrender charges, penalties for withdrawing money before a specified period, often 6 to 10 years, can run 7% or more in the early years. According to FINRA's Investor Education Database, variable annuities are among the most complained about investment products in the country. The commission to the selling advisor can be 5 to 7% of the invested amount paid upfront. The financial incentive to sell these products is enormous. The financial benefit to the buyer, relative to simpler alternatives, is rarely demonstrated and frequently negative. Situation 3. Your advisor's portfolio has consistently underperformed a simple index fund. This is the most direct test available. According to the SPIVA scorecard S&P Indices versus Active, published semi-annually by S&P Dow Jones Indices over any 15-year period, more than 90% of actively managed U.S. equity funds underperform their benchmark index after fees. Over 10 years, more than 80%. Over 5 years, roughly 75%. The pattern is consistent, it's held for decades, and it applies across asset classes and geographies. If your advisor's portfolio has lagged a simple S&P 500 index fund over the past 5, 10, or 15 years, which statistically it likely has, you have been paying for underperformance. Situation 4. Your advisor's compensation is tied to the products they sell, not the outcomes you achieve. This isn't always visible from the outside. The questions worth asking directly: are you a fiduciary, legally required to act in my best interest at all times? Are you fee-only, meaning you receive no commissions from products you recommend? What is your total annual compensation on my account, including all fund expenses, advisory fees, and any revenue-sharing arrangements? Do you receive any compensation from the funds or products you place me in beyond what I pay you directly? A genuine fee-only fiduciary will answer every one of those questions immediately and in plain English. Situation 5. You have a genuinely complex financial situation that warrants professional advice, but you're paying for ongoing management when what you actually need is periodic consultation. Financial planning that genuinely adds value covers tax efficiency, estate planning, insurance adequacy, Social Security optimization, Roth conversion strategy, withdrawal sequencing in retirement. These are areas where professional expertise applied to your specific situation can produce outcomes worth many times the cost. The best model for delivering that value is typically a one-time or project-based engagement with a fee-only CFP, someone who charges for their time, not a percentage of your assets. A comprehensive financial plan from a fee-only CFP typically runs $2,000 to $5,000. A 1% annual fee on a $500,000 portfolio is $5,000 every single year, indefinitely, for ongoing management that may add almost nothing after the initial plan is in place. Situation 6. You've never actually looked at your real investment costs and compared them to low-cost alternatives. This is the most common situation of all because the financial industry has zero incentive to make these costs visible and every incentive to obscure them. Fund expense ratios are disclosed in prospectuses almost no one reads. Advisory fees appear in account agreements. Most clients sign without scrutinizing. According to a 2025 Charles Schwab survey, 61% of investors with advisor-managed accounts could not accurately state what they paid in total advisory and fund fees the previous year. The story that makes the math human. There's an accountant in Atlanta who worked with the same advisory firm for 11 years. He trusted them. He liked them. His portfolio had grown, which he attributed to their management. He had never looked at the underlying fund expense ratios, never calculated the advisory fee as a dollar amount against his total returns. In 2024, his daughter, a second-year finance student, sat down with him and built a simple spreadsheet. His total annual costs, advisory fee plus fund expenses, were running at 1.87% of his portfolio. Over the previous decade, his portfolio had grown at an average of 6.1% per year. The S&P 500 had returned approximately 12.8% annually over the same period, and a total market index fund available for 0.03% per year had returned roughly the same. He was paying 1.87% a year for a portfolio that trailed a free benchmark by 6.7 percentage points annually for a decade. He didn't switch because of a scandal. He switched because of a spreadsheet. He consolidated into 3 low-cost index funds at a major custodian, scheduled an annual 1-hour review with a fee-only CFP at $300 per hour, and redirected the fee savings back into his portfolio. Based on his daughter's calculation, the change will add approximately $400,000 to his retirement outcome over the next 18 years. The advisors weren't dishonest. They were operating within the rules of an industry where those rules permitted exactly what had been happening to him. That guy didn't lose money to fraud. He lost it to a spreadsheet he never built. When was the last time you actually looked at what you're paying, not what you think you're paying, but the real number? Drop it in the comments. What to do right now? The unifying principle across all 6 situations is this: every dollar of fees is a dollar that never compounds. A 1% annual fee on a $400,000 portfolio is $4,000 per year. At 8% gross returns, that $4,000, had it stayed invested rather than been paid out, would grow over the next 20 years to approximately $18,600. Every year of fees costs you not just the fee, but the compound growth the fee would have generated. The math is silent and invisible, which is exactly why it accumulates so effectively into enormous sums over decades. The practical steps: download your most recent account statement and look up the expense ratio of every fund you hold on Morningstar.com or the fund company's website. Add those expense ratios to your stated advisory fee to get your all-in annual cost percentage. Multiply that percentage by your total portfolio value to get the annual dollar cost. Then go to Vanguard, Fidelity, or Schwab and find the expense ratio of a comparable total market index fund. Calculate what the same portfolio would cost annually in a self-directed account. The difference is what you're paying for active management and advisory services. Decide whether the specific, demonstrable value you receive from those services justifies that number. The financial services industry is not full of bad people. It's structured by incentives that don't always align advisor compensation with client outcomes. Understanding that structure and choosing your place within it deliberately is the difference between paying for expertise and paying for the appearance of expertise. The person who knows what they're paying, why they're paying it, and what they're getting in return is in a fundamentally different position than the person who assumes the relationship is working in their favor because it feels like it should be. Assumptions in personal finance are the most expensive things you can own. 2 questions: are you a fiduciary? And are you fee only? Cost nothing to ask and are worth potentially hundreds of thousands of dollars to have answered honestly. Ask them.